All right, on today's show, we're covering tariff barriers versus profit surpluses.
Why America's profit power still crushes the world, and it makes up more for the deficit than people think.
De-dollarization, is that the real reason why gold is rallying, or is there some way bigger picture revolved around geopolitical risk and other currencies?
What is the government doing now to look at health? Well, they're attacking one of the areas of the most profitable areas in the country, that's pharma, and with good reason. And this may not create the opportunity for pharma that other people might be thinking.
Wall Street's wrong again. CrowdStrike was just recently upgraded. We'll give you the truth behind the numbers.
Earnings uncensored of Illumina. Illumina is a stock that has taken a little bit of a hit, but it's got some interesting people coming in. And does that mean that maybe it's an opportunity for getting into Illumina? Maybe. Check that out now.
Everybody wants to talk about tariffs and whether or not tariffs make sense or not and what Trump is doing and if he should or not. What everybody's missing is the real story for the U.S. and the U.S. economy is profit surpluses and the fact that we have a massive one. Joel, let's take everybody through why people are probably focusing on the wrong stuff for the U.S. market and economy right now.
Yeah, so let me just share with you. We have a database of 32,000 companies in the world. No one else has anything that comes close that actually publishes research. The calculation we did is, first, you have to get the world on one accounting, and the fact is you have to use uniform accounting for every country in the world. China does not use the same accounting. Their calculation of earnings could result in a company having higher or lower earnings, or the same with the rest of the world. So if we get everyone on one playing field, here's what you see that's so amazing, is that while the country, the U.S., has a trade deficit with the rest of the world, the amount that the U.S. made in 2012, let's go back to 2012, the amount of profit was close to $600 billion, right? $550 billion. The amount of economic profit that China made that year was barely $20 billion. The amount of profit the rest of the world altogether made, the world excluding the U.S., meaning including China, was maybe around $180 billion. Now, this is still coming out of the great financial crisis, so a lot of countries are reeling. But the fact is the U.S. came out much sooner. In 2013, that continued. By the way, in 2013, Europe really started taking a hit from the austerity measures they were putting in, the problems they were having with the pigs, Portugal, Italy, Greece, and Spain. Europe and the ECB not getting their act together post-great financial crisis. And so the U.S. continues to generate a profit, and the world doesn't, right? So, yes, in each of these years, 2014, we see it continue, 2015. Basically, the world does sell, but they make an economic profit of zero in 2015, 2016. It's not until 2017 that Europe started generating a little more economic profit. It took them 10 years to recover from the great financial crisis. But even then, right, what is this telling you? It says that while the U.S. may have a trade deficit with the rest of the world, on the amount of revenue the U.S. sells to the world, the U.S. makes more money in profit than all the rest of the world makes selling to all the rest of the world combined. Do you see what we're getting at? So this is how a country can still be an economic superpower, because at the end of the day, if you had a business with all the revenue in the world, think of GDP, think of trade, think of whatever, you have all the revenue, but you have no profits or small profits, is that a good business? What you're looking at is the rest of the planet does not know how to make a profit on the trade that it has with the rest of the world. And the U.S., this is 2022. Now, the reason I'm showing these slides these are the exact slides that I shared with the Pentagon. I've discussed this with the Heritage Foundation, with some of the top institutional investors in the world, our clients. And this insight that the reason why the U.S. can remain an economic superpower despite 3 or more decades of having a trade deficit is because it has a profit surplus. And because of the profit surplus, the U.S. has more money to tax. You can't tax revenue. Countries, I mean, they've tried, and when they tax revenue, they shrink the economy. But you can tax profits, right? And this is what's happened, is other countries are like, well, we don't have profits to tax. So China is amazing, right, in terms of it has pretty much half of the profit that the whole world generates is in China, excluding the U.S. But the U.S. generates more in profit than the entire planet combined. I'm talking about triple. And this ends in 2022. It got better in 23 and 24. That's some of the slides that we show with the research we show with their clients is showing where it's headed. So when people wonder, why is it that the United States has a market cap bigger than the market cap of U.S. equities is bigger than the entire rest of the world combined. That's a truism. I mean, look at number 2, number 3, number 4. It's a blip. It's not even close. And even if you add up all of the world combined, you don't get a profit or a market cap the same. And people say, well, maybe the U.S. is in a bubble. No, it's because the other countries don't generate a profit. And at the end of the day, what's valuable? Revenue? I mean, revenue is nice, but if revenue results in little or no profit, guess who you end up with? Little or no value, little or no taxability or taxation. So, Rob, this is the stuff that we've been talking about, and we've been talking about with our biggest clients, and we thought it's time to share this with the world, right? With our clients. But the fact is, this is U.S. market cap, but it's backed up by U.S. earnings, and that's what we're seeing. Now, no one's talking about that. All right, no one is talking about the fact that the U.S. has had a profit surplus that exceeds the rest of the world combined, right? Despite having a trade deficit, which is, all right, it's not great, but so what at some point?
And I think you said it, right? It's so right. It's the issue is when you talk about GDP or you talk about trade deficits and the fact that we have a $1.2 trillion trade deficit, there's that thing you said, Joel, is so important, that idea of that's revenue. Let's talk about how profitable that revenue is, because there is so much that we buy from other people that there's a reason why the U.S. doesn't make it, right? Because the fact that it's low margin products, and we go, yeah, no, we'll let you all make that. We're going to make the high profit stuff, and we dominate in the high profit stuff. So I mean, Joel, tell me if you'd say this is fair, but I think the real point here is that kind of when you think about the tariffs, it's like, look, we've been fighting with one hand tied behind our back in terms of we have always had since the 1940s, 1950s, had an open market. Well, we let everybody else kind of have tariffs to, because of the fact that we are so much more competitive than everybody else is. And now we're saying kind of what happens when we don't fight with a hand tied behind our back in terms of in global trade and we actually unleash the entire economy. I mean, that's kind of what you're saying, right? Is imagine how much better this could be if all of a sudden the playing field was level. Is that fair?
So, yeah, what's amazing is the U.S. has achieved, right, more profit than the rest of the world. And again, profit matters. If you tell me, hey, I own $1 million business, $1 million in revenue, and then someone says, well, I own a $3 million business. You're like, yeah, but my $1 million business produces 300 grand of profit. And the other person with the $3 million business says, oh, I produce like 10 grand of profit. Which business would you rather have?
Or it's China and they barely produce a profit. They don't even produce a profit at all.
That's it. Now, when we say profit, we're talking about economic profit. You can't use GAAP accounting. You can't use international financial reporting standards. You can't rely on China's accounting standards. They're all different, and they're different from year to year. Meaning, when you start trying to do this over years, so the one thing that we took the time to do, the reason our clients use our work, is because we said we're going to put everybody over time on the exact same calculation of earnings, so nobody can say, oh, we don't deduct this, or we get this deduction, or we actually count that as revenue, where another country says, well, we're not going to count that as revenue. We want everyone on the same playing field. And what it says is, I would suffer a trade deficit all day long in exchange for a profit surplus that exceeds the rest of the world. And that explains why sometimes people sit back and like, how can the U.S. have a trade deficit for 30 years and still be solvent and still be business? Because the profit, which really matters, right, is so much larger and exceeds everyone. And that's what, frankly, people tax profits and income, right? You can't tax revenue that doesn't produce a profit. You're just going to force the company to shrink. And that's what a lot of countries are doing, actually.
And so the takeaway, Joel, right, is look, everybody thinks that tariffs have been a big reason why the market has plummeted, 10, 15% in the last month and a half. The reality is tariffs actually might unlock the already powerful U.S. economy even more by leveling the playing field and all of a sudden making everybody realize, oh, if those tariffs cause other people to lower tariffs, so we're now on level playing field, it means you want to buy more U.S. You don't want to buy less U.S. and be running from the U.S. You want to actually get into the U.S. economy even more because we already are crushing the competition, and all of a sudden if the playing field is leveled, things are going to change a bunch. So that's why everybody...
By the time people watch this, April 2nd will have occurred, and we're going to see what tariffs, right, the organization, Trump and his agencies are going to put on the rest of the world. But what you're going to find out is how the rest of the world puts tariffs and non-tariff barriers, which we're going to talk about next time. The NTBs, the non-tariff barriers that the rest of the world has put on the U.S. are so egregious, so nothing like what the U.S. has put on other countries, the other countries put on buying U.S. goods. And because of that, as Rob says, that's the one arm tied behind people's backs. It's funny that they talk about and again, this is for the next time we speak, but the world talks about, oh, well, if the U.S. does this, then there will be retaliatory tariffs. So we're like, these are the retaliatory tariffs. What Trump is talking about are putting on tariffs on countries that put it, and it's not just tariffs, it's the NTBs that are really sneaky. And I think that's what we're going to talk about in our next show. So stay tuned, and we'll keep this going and keep this this conversation continue. But that's something I don't think people are hearing is the profit surplus is so important.
Exactly. And look, everybody, the next big thing that we've heard a lot of people talking to us about and asking us about, because many people, Joel, know your view on gold, is this rally, this 50% rally in gold because of de-dollarization? The fact of the matter is, no. There's a whole entire other big issue that's going on that when Mohammed Al-Arian and everybody else are talking about, oh, this is a sign of de-dollarization of gold, you're missing the point. Because look, when you look, Joel, right, I mean, the dollar index is basically flat for the last year and a half. So what do you think is the real reason why we have seen gold explode if you don't think it's de-dollarization?
Well, it's definitely not de-dollarization. I mean, years ago, I'd say before the pandemic, 8% of the world's trade settled in dollars. Today, it's closer to 13, 14, 15%. Settles in dollars, right? If you want to buy stocks, and the U.S. stock market is bigger than the rest of the world combined, and you want to get dividends, then the U.S. corporations pay more dividends than pretty much any other part of the world, right? Or if you want bonds, corporate bonds, you're forced to put those into dollars, right? If you want U.S. treasuries and get a healthy 4%, while Japan is paying 1% and other countries are paying 2%, you want a healthy 4% guaranteed, of course you're going to put your money into, you're forced to put your money in US dollars. And when I say you, I mean every other government, every other sovereign, everything else. So the reason why gold is up isn't because the dollar is the problem. It's because everybody else's currencies are the problem. And so this idea that the BRICS are going to get together and create a new currency when each of them cannot possibly manage their own currency well. I mean, so first, let's just talk about the BRICS. This is the Brazilian real to the US dollar. Collapsing, absolutely collapsing over the past year, and it hasn't been great. Let's talk about, right, the Russian ruble. Well, we know what's been happening with the Ukraine and everything else. This has been terrible. Despite 20+% interest rates that Russia's put on to try to improve the value of the currency, it's still collapsing. The government of Russia is doing everything they possibly can, and it's still not working. And the ruble is collapsing to the lowest levels we've seen in pretty much forever, right? If we talk about the Indian rupee, right, I'm walking through the BRICS now. The Indian rupee is getting destroyed, meaning that currency is losing value on a daily basis. Let's move on to China, right? What's crazy is China has a massive problem, which is while at the same time, this is over a longer period of time, while the Chinese renminbi, the Chinese yuan, has been decreasing in value, China internally is also experiencing deflation. I want to tell you, this is a problem for China of epic proportions, that the value of their money is falling, and yet the prices of their producer gate, things coming out of the producers, manufacturers, is falling at the same time. This is not a currency issue. This is no one's buying the amount of products that China's trying to supply.
Disaster.
It is going to be horrible for China. And so and then, by the way, throw in the S in BRICS for South Africa, right? This is not doing well either. All these are collapsing versus the dollar. So the issue of why gold is running isn't because the dollar is getting destroyed. It's because every other currency in the world and every person in China is saying, should I keep my money in the bank in renminbi or should I buy gold? Right. If I were in South Africa, would I leave my money in their currency, or would I buy, I don't know, Krugerrands or whatever else? Right? If I'm in Brazil, if I'm in any of these countries, I'm going to do everything I can. So when you have an increase in the demand for gold from, I'm going to say, very large portions of the world, and the amount of gold created every year is what, 1.8%? You can only grow the gold by something like 2% a year. It's less than that, I think. 2% a year. But the demand for gold suddenly increases by 4, 5, 10, 15% in these countries. Of course the price of gold is going to go up. And it deserves to. I'm not saying it doesn't. I'm saying when you have this kind of currency devaluation everywhere but the U.S., that is a sign that gold belongs where it is. But to say that gold is going up because of currency devaluation of the dollar is just not. Robert Kiyosaki is another one, right? The rich dad poor dad guy who keeps going around for the last 10, 15 years saying the dollar is worth whatever. Look, I'm not saying the dollar didn't take a big hit. It did during the pandemic and during the Biden administration, right? But once the Fed started raising, and not even, just on the first 2 years of the Biden administration, but once the Fed started raising rates and cooling the economy down, the dollar's gotten stronger against everyone. Now, I'm not saying I would invest in dollars. This is not what we're saying. We're simply saying that the reason gold is going up is not because of the dollar,
exactly.
it's because
It's
of
not going to be. And there's something to be said, Joel. The nice thing about a broken clock is it is at least right twice a day. It is staggering that Robert Kiyosaki has literally not even been able to get that right. Right? He's not even been as right as a broken clock. It's wild.
Kiyosaki,
and if you look,
Arian, these discussions have been, it's like every year it's going to be a massive recession. Every year the dollar is going to collapse to zero. It's worthless. Buy gold, put gold bars under your mattress. Look, if you want to make a gold trade because you realize that the rest of the world's currencies are in deep trouble, right? And as Rob's going to talk about in a second, the geopolitical issues, because gold historically goes up with geopolitical issues, tensions, war, whatever, and currency. And they kind of go together. And I'll let Rob talk about that. Rob.
Yeah, Joel, yeah, you're exactly right. You think there's a healthy Venn diagram in terms of buying of gold because of currency destabilization and buying gold because of geopolitical risk. And if you look in 2024, the biggest buyer of gold was Poland. And Poland isn't buying gold because it thinks that the zloty is going to collapse. It's buying gold because it's right next to Russia, and it looks at what happened in Ukraine and goes, I'd rather have some hard assets to be able to do this. If you look at the rest of the biggest buyers of gold, Turkey on the other side of the Black Sea from what's going on in Ukraine, right? Not doing too great there. Also Azerbaijan, right outside of Russia. You look at Uzbekistan, you look at Hungary, you look at Serbia, you look at Georgia, right? Georgia, which literally has been, everybody talks about Ukraine. When Ukraine was invaded, Georgia was invaded by Russia also. Just nobody talks about it anymore because it's not that big of a country. All these countries, right? It's the reason why they're buying gold isn't because the dollar is collapsing. The reason they're buying gold is because they're worried that, oh, holy cow, there might be a lot more geopolitical uncertainty. That's an invasion of my country. I'm going to need some hard assets to buy stuff. And the best part is, right, Joel, is they talk about all this, but they're not even storing it in their own country. They buy it and then they store it in the U.S. because they know that's where it's going to be safe.
It's funny the amount of gold that's left the UK because people are worried that given the UK's terrible administration of Brexit and everything else has been crushed in the UK. But the fact is the reason why the dollar's stronger is let's say you're in Poland, let's say you're an individual in China, let's say whatever else, and you want to invest in the best passive investment in the history of the world, which is stocks. Passive, meaning you're not actively trading. You just buy U.S. stocks, and the performance you get is fantastic over 10, 20 years. Fantastic. You have nowhere to go but the U.S., right? But the U.S. for stable, long-term stock appreciation and the dividends. If you want bonds or T-bills, where are you going to go? If you want a good interest rate and with reliable, safe, things like bankruptcy law, you don't have that in China. If a company in China says, oh, we didn't make our interest payment, you can't go and sue them and put them in default. That's up to the Chinese government to decide whether or not they're going to do anything. Or they just say, sorry, we didn't make your interest payment. We'll make it next time, right? So if you want assurance of interest payments, you want assurance of your principal back. If you want to invest in venture capital because you want an extra higher return, well, the world's venture capital funds, right, are smaller than the U.S.'s. Let me say it a different way. U.S. venture capital is easily 3, 4, 5 times bigger than the rest of the world's venture capital combined. U.S. angel investing is 5 to 10 times the rest of the world combined. The U.S. produces more oil and gas than any other country. The U.S. produces more technology than any other country. The U.S. produces, even in food, right? Number one calorie in the world isn't rice. I thought it was. Number one calorie in the world is wheat. And the world buys wheat more from the U.S. than any part of the world. So if we talk about the SWIFT systems and banking and whatever else, at the end of the day, the reason why the dollar is remaining, right, the reserve currency and will for the rest of this century is because of things you see getting put in place, especially what's happening with the terrible, right, currency issues that all the other biggest currencies in the world are having. That's why gold is running. And it may continue to run. I'm not saying don't buy gold. I'm saying it's an interesting trade as long as you see all these other countries destroying their currency and doing things like going to war, because war is currency devaluing. The worst 100%. Currency devaluation that happened in Japan was World War II. That happened in Germany was World War I and World War II. If you go around the world and you want to see what happens to a currency that gets destroyed, that collapses, it's always associated with war, because nothing is more inflationary than spending more money to destroy things. You have less stuff around and you have more money around. Well, what does that do? Of course it causes inflation, and you've seen that. So gold may still remain to be a great trade for a 1 year, 2 year, 3 years, who knows? It could be. But it isn't because the dollar's de-dollarizing or because the U.S. stock market fell by 10% in a correction. that is going to have a rebound at some point. Maybe not yet.
Yeah, exactly. It is. Let's stop pointing the finger in the wrong direction here. So, let's talk about Make America Healthy Again, and specifically about the rumors that came out earlier this week as we're filming about RFK Jr. saying we're going to shut off pharma advertising. Now, look, yes, we know, as anybody who wants to dig into this knows, that the reality is that's not true. He did not actually say that this time, now that he's the head of the Health and Human Services, though RFK has said this a lot. He has said this multiple times when he was on the campaign trail, before he became part of Trump's ecosystem, and he's talked about it before. And let's talk about the reason why. The real reason why is actually very apparent when you get into looking at the real economic profitability of healthcare. And Joel, I think that there's something important to understand here, right? In terms of where profit distribution happens in healthcare and how that's the secret for what we're actually talking about for why it might be that RFK is targeting the pharma industry. Fair?
Well, I mean, healthcare and tech are the two biggest sectors, right, in the United States. Across the S&P 500, it's tech and healthcare, right? And that means healthcare is one of the most profitable sectors of the United States. That's why the market cap is so big of those companies. But when you dive in, you say, why is healthcare so profitable? It's obvious. It's because of pharma. More than half of the total earnings of the total healthcare of the U.S. economy, right, is because of pharmaceuticals. So what that means is they're unbelievably profitable. Unbelievably profitable making cash. And yes, there is something to be said for it takes us 10 years to make a drug, and we lose money for those 10 years, 15 years, maybe 20 years. But then when they do make money in a drug that works, holy moly, do they make cash, right? Relative to any other healthcare business. And frankly, relative to even you start looking across, save NVIDIA and the big tech companies, the Magnificent Seven, pharmaceuticals, right, are the profit makers of the United States.
So everybody, to walk you through what this chart shows you is this is for the uniform accounting. Once we clean up the accounting, the uniform earnings that the healthcare sector produces. There's roughly about $330 billion of profits that U.S. healthcare companies make when we clean up and we see through the noise. Pharmaceutical and biotech make up 52% of that. So when we talked about $1.2 trillion of profits that all U.S. makes, think about this, right? 330 billion of that comes from healthcare, and most of it comes from pharma and biotech. And so often people talk about, they talk about how do you cut costs in healthcare, right? Obviously, in entitlements, Medicare and Medicaid are two of our biggest entitlements. And they talk about the idea, well, the biggest expense that we have, the biggest revenue, it's in care. So we attack hospitals, right, and say, hey, how do we cut costs in hospitals and everything else? But that's looking at the equation the wrong way. Hospitals, relative to the amount of revenue they generate, just for perspective, again, pharma and biotech, 52% of profits, it's only 10 to 15% of the costs in the healthcare system, but it is the lion's share of the profits. And so when you look at when Kennedy talks about the idea of breaking that relationship and stopping with pharma ads, part of the issue that he's facing is this issue that we've talked about before, which is this idea that the U.S., on average, a U.S. consumer pays 3x the OECD, the other developed world average, on any drug. And the reason for that is because we view drugs as a consumer product that we're buying, because that's what the ads tell us to do. Go tell your doctor, go ask your doctor what to do. Any person who's in the world of public health will tell you that's a terrible setup. Any doctor would tell you that's a terrible setup. Anybody other than pharma lobbyists would tell you it's a terrible setup to have. But the only way that we can break that crazy prices that we have is if we first break the relationship between pharma and the consumer. And this would be the first step if it actually happened, which is why it actually makes a ton of sense. And it is one of the few things that from a bipartisan perspective, pretty much everybody agrees would be a really good idea for us to do, which is a really hard thing for you to get a bipartisan agreement on anything RFK says. Certainly there's views on both sides of the equation, but this one everybody says, yeah, of course. And the best part is the biggest spender on healthcare in the U.S. is the U.S. government. And so if this actually happened and then it broke the relationship, there could be huge savings for the U.S. government, which is why it makes a ton of sense for it to happen. Because, right, if you look, Medicaid pays $105 billion on drugs. Medicare, I'm sorry, Medicare pays 105 billion. Medicaid pays 130 billion before rebates. And Medicare also, right, it's 145 if you add Medicare Advantage. And then the VA spends $12 billion. Now look, all of them get a discount on what the list price is for drugs. So let's say it's not 3 times the OECD average. Let's say it's 2 times the OECD average. Yeah.
It's not that
yeah, exactly.
Discount if it's $250 billion.
Right, exactly. And so if let's say that we were able to get that discount, that premium that we're paying from the OECD, maybe it's 2 times. 2 times to 1 times, that's $120 billion of savings for the U.S. government. When you talk about maybe $1 trillion of savings from the U.S. government that we're targeting, because I think we've all given up $2 trillion from Doge and from everything else, that's 12% on the way there just on this alone. So I think, Joel, right, what we would say is, hey, look, one, this makes sense, and 2, this definitely gives us the takeaway of anybody who thinks this is an opportunity to blindly buy pharma dips because pharma's gotten beaten up so much, I think we'd agree, Joel, right? This is not the opportunity to do that with that headline and that logic behind it.
Yeah, so back in the Clinton administration, right, and it is relevant, right? Hillary was tasked, the wife of the president, right? She did not hold office. She was tasked with reforming healthcare. And the stuff she talked about, right, scared everyone, spooked everyone. Healthcare dropped by 20, 30, 40%, right, in terms of market. And I remember talking to some clients and some investors who said, this is the biggest buying opportunity ever. And I said, why? They said, because none of these things are going to stick. There's no way it's going to make it through Congress. It isn't Bill Clinton doing it. It's Hillary, who at that time had no official office, right? Had no official office. And they were saying, this isn't going to go through, and this is a buying opportunity. That made sense. This is not that. This is where some of these things may stick. We may see those generous profits. Look, pharma's still going to be profitable, right? It's just that, is it going to be as profitable as it has been, which has been egregiously profitable? The answer is probably not for the benefit of the consumer, to the benefit of the taxpayer. The benefit of the government is that probably it won't be as profitable, and yet still more than profitable enough to fund all the R&D needed for the next drugs of the next 5, 10, 15, 20 years, right? That's the balance. You don't want to take away all the profits, because they take the profits, they reinvest it in R&D. That's a very important thing, right? It's very important. But I think there's a lot of wiggle room between we're going to hurt the pharma companies from investing in R&D versus they're making money hand over fist on the U.S. consumer. So I think this is not the time to be buying the pharma dip because of these issues. I mean, maybe it's 50-50. I'd rather have 3-1 that you're going to buy something versus 50-50. So 50-50 on this, I'd walk away from that trade.
For sure. All right. Wall Street's wrong again. And this time they're wrong on CrowdStrike. So for background, CrowdStrike is a company that many people in the analyst world are saying they like, but when you dig into the numbers, as we'll show you in a second, valuations say maybe they're actually not being honest when they tell everybody to be a buyer. And so, Joel, right, we saw this because BTIG upgraded the company, upgraded CrowdStrike to a buy and said their target was 431. But maybe can you walk everybody through this chart? Because this chart tells the truth, I think you'd say, about whether or not Wall Street really likes CrowdStrike as much as they're trying to tell you they do.
So BTIG is just another one of the Wall Street sell-side research firms. Our clients would tell you, you would never trust a buy-hold rate. Buy and hold is 95% of Wall Street ratings on CrowdStrike right now. Buy and hold. Do you know what that means? It means they want to make sure they get their banking business. So they say buy and hold. But if you look past the buy and hold, the recommendation of it's a buy or it's a strong buy, you say, but what's your target price? What's your target price? And so what you see is the stock over the last year. Peaked around $450. It's taken a big dip. It's now around $360-something. But those blue dots you see, right, is we've mapped all the target prices of all the investment banks covering them. And if you notice this, literally only one is above their 52-week high. And this is a target price for the company for 12 months from now. So they're saying, buy the stock now, hold on for 12 months. And despite the fact that pretty much everyone covering the stock says buy and hold, you literally have half of the target prices, almost half, are below the current price. So the target price 12 months from now is below the current price, which is already way down from 450. And you have all these people saying, oh yeah, it's a strong buy. You know what this is?
Well, I mean,
I worked on
Wall Street analysts. Wall Street analysts But Wall Street analysts were taught, Joel, right? They were taught the rule of buy high and sell low. So understandably, they'd say it's a buy when they think the stock's going to fall, right?
Yeah, I mean, the fact is, if the Wall Street analysts were actually good at stock picking, they wouldn't be Wall Street analysts. They'd be working in a hedge fund somewhere, making 3 to 5 to 10 times the amount of money they're making as a Wall Street analyst, right? A lot of Wall Street analysts even tell you behind the scenes, they'll say, I wish I could just be an industry company expert and not have to actually push a recommendation of buy, hold, or whatever else. They literally say that. They'll say it behind the scenes, but they won't say it as much publicly. But either way, if the target prices are, first off, 99% below their 52-week high was just a couple months ago, right? And if on top of that, half of those are below the current price, does Wall Street really like this company with their 95% buy hold? Absolutely not. It's BS. It's absolute BS. And I'll tell you, our institutional investors know that already. If I showed this slide to our biggest hedge fund clients, they'd be like, yeah, we know that, of course. Why would we ever look at that? And yet, for some reason, the public still says, and CNBC and Bloomberg, oh, so-and-so gave this company a buy rating, and their target price is whatever. You're like, have you actually looked at the target price and where it is relative to where the stock has been over the last year? That is not a buy. That's a joke.
Right?
It's a joke.
Yeah, upgrading for 15% upside is silly. But Joel, so now let's talk to people about the reality of CrowdStrike and whether or not anybody should think this is a buy. You want to take them through what we see when we see the real numbers?
So what we're looking at right now are the gap accounting as reported in FactSet in Bloomberg. And I always say this, but look it up in Yahoo Finance if you want. What is the return on assets? You'll see a negative number, negative or zero for the last 5 years. Now, how does a company achieve a $91 billion market cap if it had 5 years of negative returns? It's because there's no institutional investor. And by the way, this company is owned 70, 80% by institutional investors, meaning our biggest clients, right, that own this. And you're looking at a return which is not negative and getting better. It actually is post-peak and getting worse. That is the statement to read. Now, if we look at what's embedded, we can say, okay, let's get rid of the BS accounting numbers, the gap accounting, which nobody would ever pay attention to who's any good at investing, right? And then we look at the Wall Street analyst estimates. You can see why Wall Street is down. So we take the aggregate Wall Street financial forecasts, not the EPS number, which is a garbage number. EPS is based on gap accounting. We actually take their individual line item financial forecasts, line by line, aggregate them, and you can see that, okay, they think 2027 is going to be a little bit better than 26, but 26 is going to be even worse than they've had in the last 5 plus maybe 10 years, right? And it's only going to improve slightly. Now, to get to their stock price, we have to have, just to justify 91 billion market cap,
nosebleed.
Right? You need these returns to skyrocket to quadruple, triple, quadruple of where they are right now, right? And I'm just going to tell you right now, that is not a bet I want to make. They say that Warren Buffett says, I don't look for 7-foot hurdles to jump over. I look for 1-foot hurdles, right, to step over. Well, this is the line. This is what's priced in. 70% return on assets in perpetuity. That's better than Apple. That's better than Coca-Cola. That's better than I mean, this is maybe in
basically. I mean, almost anybody. Right. Yeah, exactly.
Right. It's not achievable.
And to take everybody back now that you all have the lay of the land, right, in terms of what the real numbers show us for reality, let's talk about CrowdStrike and let's talk about why return on assets dropped in 25 and it's going to drop in 26. And what the actual take is here, because this is when it becomes laughable in terms of this upgrade, anyways. Of course, Joel, you already showed nobody actually has a buy on this name based on where their price targets are. But so for CrowdStrike, right, IT cybersecurity provider, everybody there, if you remember from the news, the ones who had the massive IT outage in 2024 that shut down Microsoft, that shut down a whole bunch of other things. It was just a total disaster. And so because of that, they lost a ton of business. Well, when BTIG came out with this report to upgrade CrowdStrike, they said, well, the reason why is because we think that by 2026, second half 2026, mind you, a year and a half from now, we think CrowdStrike will finally have put behind it the IT debacle that it had, and we think it's going to return to growth in 2026. They're telling you to buy a company who literally needs to, as you said, Joel, quadruple its profits. Because the fact that it might return to growth in 2026, and I think you and I would both agree that's just laughable. And this is a reason why, again, Wall Street's wrong, and you just need to ignore what they're saying because it ain't the truth.
And it's funny, it's Wall Street's wrong again on their buy hold recommendation, but if you look at their target prices, and
Right.
half of them are
It's a bit
below,
more honest.
half a third of them are below current price, it's like sort of, this is the nudge, nudge, wink, wink. This is what I saw happen every day when I was in investment banking, is people say, oh, I've got a strong buy on this stock, right? For the public, for the CFO, for the CEO of the company to hear, for the bankers who are trying to get the business say, oh, look, we like your company, it's a buy, it's a strong buy. And then it's like a nudge, nudge to their best investor clients, don't touch the stock. Don't look at my
Right.
target price. Don't look at the buy, look at the target price, right? Don't look at this hold. Hold means hold, right? Should I hold the stock? Should I keep it, right? Versus, no, look at my target price. So given that all those, express what they're looking at, which is this company is crazy expensive, I would not bet on that kind of hope that you won't even know a year and a half from now is good. Check it out a year and a half from now. Maybe by then we'll have seen it work through its problems, and maybe there's a different opportunity. But by then, won't they have other competitors? Well, aren't there other companies doing this kind of work? I mean, of course there are. So, yeah, I'd walk away. Walk away.
All right.
Run.
Let's talk Illumina, the DNA sequencing company, and let's actually show you the reality behind its censored earnings. Let's talk earnings uncensored. Illumina is a really interesting potential setup right here. Not saying we're recommending Illumina, but let's talk about what's going on, because Corvex, Joel, a company, a fund manager that may be familiar with uniform accounting. Do you think that's fair to say?
I would say so, yes.
Yeah, right. Perhaps, we may have had a conversation or two with them in a past lifetime. So Corvex,
230 of the biggest 300 money managers in the world have been using our research at some point or another. I would put them in that category.
yeah, that's fair. So Corvex is a really well-respected activist fund, and they just recently won a battle to get on. I don't even know if it was a battle, to be honest, to be fair, to get on Illumina's board. Right now, they have board seats, including Keith Meister, who is the founder of and head of Corvex, is now sits on Illumina's board. And when you look at what Corvex is doing, we actually think that Corvex might have a pretty smart buy the dip opportunity that they're saying here, because normally activist investors have to do a lot of work to get a company to get from where it is to a higher valuation, and that's why they're active on it. But this one might be, Joel, we think just based on valuations alone, might be one that's a little bit easier to see what Keith and what Corvex is saying. Is that fair?
Yeah, what is the hurdle, right? Is this a 1 foot hurdle like Buffett loves, or is this a 50-foot hurdle like other companies that we've looked at, for instance, I don't know. CrowdStrike, for instance, right now. So Illumina, this is its GAAP accounting numbers. It actually looks like it's a really, really bad business and has gotten worse in 22 and 23, but somehow is improving in 24. In reality, under uniform accounting, this is not the GAAP accounting, but the uniform numbers based on getting everyone on the planet on the same uniform adjusted financials. This is non-GAAP uniform, right? Non-GAAP uniform. It says, yes, they had a great year in 2021. It dropped in 22, but it's been rebounding in 23 and in 24 fiscal year, right? Now let's see what Wall Street thinks. The Wall Street estimates, meaning what they really think is that, yeah, they're going to peak at this return level and it's going to roll off a little. But at least they're saying it's going to hold. The rebound's going to, at some plateau level, that's not as bad as what they had in 22 and 23. Now here's the issue. To get to their market cap, right, to get to $85 a share or a $13 billion market cap, you actually need a low hurdle. The returns of this firm could drop all the way back to almost their low in 22. And that's how you get to today's price, right? Is if they just maintain 2022's numbers in perpetuity, which are not great, by the way, you would justify this valuation at $13 billion. Now, they've had a lot of issues and a lot of headlines, but given that context, Rob, what are the story behind it that says, is this right? Or is there a reason maybe this is a low hurdle?
Right, and this is what's so interesting about this, because a lot of this is a messaging issue. It's not an operational issue. So take you all back and zoom out, right? Now that we have the reality here, we know the facts of what really happened for the business and what the market's pricing in. So that 2022 dip that Joel highlighted, that 2022 dip is all about this company GRAIL. GRAIL so as we talked about, Illumina does DNA sequencing. It is essential for all the biotech innovation we have going on, everything else. Well, what GRAIL actually does DNA testing for cancer risk. It actually used to be part of Illumina. Illumina spun it out, and then they really regretted the fact that they spun it out. So they said, you know what, we're going to buy it back. Every single antitrust regulator said, no way, this is a serious issue in terms of competition, you can't do it. And Illumina basically said, okay, guess what? We're going to close the acquisition, make us unwind it after we close it. What are you going to do, US and Europe? And then what happened was the US and Europe made them unwind the acquisition. But there was this huge distraction that they had of battling their regulators for years that pulled down their return on assets because they took the eye off the ball on their core business. Well, 2024, things start to recover, right? They start to get all right. And then what happens is earlier this year, after the Trump tariffs become a real risk, China, right, which is a decent slug of their business, labels them as an unreliable entity. Basically saying, right, Joel, these non-tariff barriers that you were talking about earlier.
Right? NTBs are non-tariff barriers. And so they might not say we're putting a tariff on, but they see a couple of businesses that they think, oh, in China, we got a couple of companies that can do what they're doing, but we don't want to tariff them because it sounds bad. So we're going to say that they can't pass our regulatory level of analysis that we require and basically make the tariff 1,000,000%. I mean, it's infinite. It's an infinite tariff.
It's impossible to buy from
You're
them.
not allowed to do business. Yeah, you're not allowed to do business in our country. It's an NTB, which I'd argue globally for a different episode, a different segment, Rob. NTBs that are hitting them, non-tariff barriers, are more severe, what's put on the U.S. by the rest of the world, than I'd argue even the actual tariffs are. But anyway, they've been hit by that. And yet, the return has improved in 24. It's not bad.
And that's the thing. And still forecasts to improve in 25 and 26 and to maintain in 25 and 26. And for context, well, China's a big part of their business. It's only like 10% of revenue. And so the market is reacting to all of these concerns about China and everything else, not recognizing, right? And basically pricing returns to fall back when it was at this worst disaster time during GRAIL, not realizing actually this business is a lot better than people realize. And probably that China story is not going to be a big deal. So what it looks like Meister and Co. are thinking, right, at Corvex is they're saying, hey, this is a messaging issue, which is a way easier issue for us to fix, and we're going to be able to clip a decent amount of upside if this stock recovers. Why wouldn't we go active on this and try to take it off? And so, Joel, I mean, I think you and I would agree, look, this isn't a stock that we're recommending in our portfolios, but this is one that we're going to keep a close watch on and potentially kick the tires on sometime soon. Yeah,
there's a Chuck Royce, the famed, one of the greatest small cap investors in history. He said to me one time, I was in his office, and he said, look, there's a bunch of companies that I really like but aren't cheap enough. And there's a bunch of companies that are really cheap, but I don't 100% like yet. But those create my watch list for what does end up in my portfolio. And this is one where I'm not sure I love the company yet, but the stock is getting cheap enough that you kind of have to say, I want to pay attention. And you get some smart investors like Corvex that are paying attention to it and putting their money where their mouth is, and you start saying, all this company has to do is, if it just maintains its returns that Wall Street thinks they can, at just this level of, call it 15-something%, and just maintain that level. Just maintain it. This stock doubles to a 26 billion market cap from wherever it is around 13. Easily, if it just maintains. And if the returns might actually go back to some generous level, it's a different story. Right now, what's priced in, right? Tons of upside. What's priced in right now is it's not the 1 foot hurdle that Buffett would love, but it's sort of like a 2-3 foot hurdle.
It's
awfully You kind of have to hop over it. You kind of have to hop over it, but it looks really interesting, and you might find it under conviction list at some point. But it's still in that Chuck Royce kind of, I like the name, it's cheap, but I don't love it yet enough to put in the portfolio, but we're going to watch it very closely.
Exactly. And so everybody, we started the show talking about Trump's tariffs, and now we're ending the show talking about somebody who ended up getting clipped by Trump tariffs in a way that nobody is really talking about. You never know how we're going to get to A from A to Z, but there you go. So thanks so much for today, and come back for the next episode.
Thank you, everyone.
All right, thanks everybody for tuning in. If you want to hear more and follow us on a daily basis, just click the first link below and be able to track what we're doing every single day.